back to another Stocks for Teens video. Before I get started, I have an announcement to make, and as you can probably tell, I've been releasing the past 2 videos every 3 weeks instead of the usual 2 weeks, and it's because of a busy schedule. If not, I'd be releasing every 2 weeks. But since I have a busy schedule, I'd like to keep it to every 3 weeks and post new content and material every other 3 weeks. This is because I'd like to give content and material that's useful and valuable to you, and not something that's rushed and hurried, because that won't be effective and that will definitely not be useful. So I'd like to keep it to every 3 weeks. With that, I'd like to introduce today's topic, which is technical analysis. If you're wondering why that seems so familiar, it's because I made a previous video about fundamental analysis, which I briefly mentioned technical analysis, and both ways of analysis are used to evaluate stock investments. But both are completely different from each other, so do not confuse them together. Before I talk about technical analysis, I'd like to introduce this video with a quote, as always, this time from Ben Graham. Ben Graham once said the individual investor should act consistently as an investor and not as a speculator. What he basically means is that you're an investor and not a bystander. So don't influence your decisions based on risks, and always keep your decisions on real-life facts and analysis, because that will only help you in the long run. With that in mind, let's get on with it. So, as mentioned before, today I'm going to be covering technical analysis. A few videos ago, we covered fundamental analysis, which is a different way you could use to analyze stocks, but both ways of analysis are completely different from each other. So don't confuse them together, because both utilize very different ways of analyzing stocks and evaluating investments. Because of this, today I'll be covering what technical analysis is, the differences between technical and fundamental analysis, and some must-know terms you need to know prior to using technical analysis. So let's get started. First off, what is technical analysis? Technical analysis is the study of historical market data, including price and volume. It basically forecasts the direction of future price movements, and it helps investors to evaluate their stock investments using this historical market data. Now, there are differences between technical and fundamental analysis, the main one being the source of information or data the investor uses to evaluate their investments. Fundamental analysis, as I've covered in a previous video, is the process of determining a stock's real or fair market value. Investors use financial statements and company reports or documents to figure out how well a stock is performing relative to the market. Therefore, fundamental analysis takes on the perspective of a business or a company, because you're viewing a stock through the issuer's lens. By looking at financial statements, you're pinpointing a stock's real or intrinsic value. On the other hand, technical analysis requires historical data or reference points to evaluate stock investments. It is based purely on trends and charts. It doesn't consider activities of the business itself. I mean, of course, by looking at the position of a company is important for an investor, but technical analysts don't usually dive too deep into the faring of a company. Tools in technical analysis are used to spot the changes in stock value if supply and demand of the stock fluctuates. So analysts are looking at how supply and demand affects the stocks they want to potentially invest in. Now, there are some must-know concepts, which I've listed all right here, that you should be familiar with in order to fully understand technical analysis. Before I cover those concepts, there's a term I've been speaking about which I haven't elaborated on, and that's volume. Volume is basically the measure of the number of stocks, shares traded on the stock exchange in a day or a period of time. Moving on, common knowledge includes knowing the different types of charts people use, the indexes, price patterns, and trends that are present. Of course, I'll not be covering everything that's there because that would take a really long time to cover, but as always, we're going to go over simple concepts so it's easier to grasp. First, let's start off with charts. The first chart is a line chart. A line chart is a graphical representation of an asset's historical price action that connects a series of data points with a continuous line. This is the most basic type of chart that's used in finance and typically only depicts a security's closing prices over time. Line charts can be used at any time but are mostly recognized when there are sudden changes in prices. Next is a bar chart, which has open, high, low, and closed data sets in a vertical line in the form of a bar. It's also referred to as an open, high, low, close, or OLHC chart. Basically, bar charts show many price bars over time, and each bar reflects changes with prices, just as line charts do. The only difference is that bar charts use bars, and line charts connect different price points with lines. The vertical line on a price bar represents the high and low prices for the period. The left and right horizontal lines on each price bar represents the open and closed prices. The final chart we're going to be looking at today is a candlestick chart, which is a chart that has open, high, low, and closed data sets in a candle form. Candlestick charts are used by traders to determine possible price movement based on past patterns. Candlesticks are useful when trading as they show 4 price points, open, close, high, and low, throughout the period of time the trader specifies. In this way, candlestick charts are extremely similar to bar charts. The only difference is that the actual body part of a candle, which is referred to as the real body, represents the opening and closing prices of the day. If the real body is red, then that means the opening price was higher than the closing price. But if the real body is green, then that means the closing price was higher than the open. Our next topic for today is averages that people use in technical analysis. To start off, moving averages are calculations to figure out the averages of different subsets of the full data set. These calculations help smooth out price data so that people can see consistent and updated price patterns. Moving averages, therefore, are stock indicators. There are 3 types of moving averages that I'm going to be covering today, and that's the simple moving average, the exponential moving average, and the moving average convergence divergence, or MACD for short. The simple moving average, as listed here, is an average of the closing price of the stock over a specified number of periods. You can calculate the simple moving average by taking the arithmetic mean of a set of price data points over various intervals of time. For example, taking the mean over a span of 10 days, 20 days, 100, or even 200 days. It depends on the investor. The simple moving average is very customizable to the technical analyst, as it depends on what you want to see. On the side, I have a graph posted here of what a simple moving average looks like. Moving on, pun intended, the exponential moving average is like the SMA, but it's a weighted average that gives more importance to the price of a stock and its fluctuations in more recent days. Basically, the exponential moving average is more receptive to present-day trends, which keeps the analyst more up-to-date. Thus, the EMA gives a higher weighting to recent prices, while the SMA takes the average over many multiple days, so it doesn't give as much importance to recent prices. Finally, the moving average convergence divergence, or MACD for short, is a more complicated index that looks at the interplay between multiple moving averages. I won't get into too much detail about this today because it's very complicated, but all you need to know for today is that the MACD is a type of trend following indicator that's designed to reveal changes in the strength, direction, momentum, and duration of a trend in a stock's price. If you would like to know more about the MACD or any of the other averages listed right here, then leave a comment down below so I might make a future video dedicated to exploring these averages in more detail. Unfortunately, time has run out for today, but as always, thank you for watching this video. Just a spoiler for the next video, we will continue to learn about technical analysis, but in our next video, I'll be covering topics like price patterns and trends that are related to technical analysis. So if you're interested, then please look out for that video. As always, don't forget to like, share this video with others, comment, and subscribe to my YouTube channel, because that's always appreciated. As always, see you next time.